Hello traders, this is the last video of the futures trading course by the C-Scalp team. This video is devoted to the most popular scalping strategies, namely breakouts and pullbacks. Let's figure out how to use them correctly. If you missed previous video, watch it by clicking the link under this video. I hope you remember from the previous video how to search in-play instruments using C-Scalp screener and signals channel. We find setups only among active instruments. Let's talk why these two strategies are so popular and worth using. First reason, simplicity. The strategies are really simple to understand and find the setups. Why it's so important? Because traders are humans and emotional creatures. When the strategy is simple, it's easier to follow its rules even under emotional pressure. The second reason, good risk-reward ratio. In both cases, we have very small potential loss against huge potential profit. Such ratio brings us positive mathematical expectation. When you have 5 losses in a row, the 6th trade will compensate it. In trading, it's extremely important because sometimes even ideal analysis could be spoiled by unforeseen circumstances. The third reason, the wide spread of setups. Such setups you can meet every day on many instruments. So let's start from the breakout. We pay attention to the 3 main rules. The formation on very active instrument. We should have very clear and visible formation. It should show us no less than 2 very visible and clear touches to the level. And of course, the compression of the price to this level. When the amplitude is getting lower and lower and the price is closing to this level. Second, we enter the breakout on very active tape in this place. Active tape means that there are enough participants that could bring the really good impulse with a good potential. So we enter the trade here by the market or placing the pending order just on the border, just on the level. We are fixing partially by placing several limit orders for sale in this case, just to be able to fix our position. We do it in advance. The reason is that the impulse could be very sharp and you will probably just make a blink of your eyes when the impulse is already over. As you see on the example, the movement is really drastic. Here you see my pending order of 500 lots, and higher you see that there are limit orders for fixation. I opened the trade with a very small part just to be ready, and my main position is placed on the border, just on the level. As you see, the instant execution and instant closing fixation of my position by limit orders. The second strategy, pullbacks. We find a huge limit order of more than $300,000 and it should be above or below strong level. We multiply the current price of the instrument by the number of coins in the limit order to know the size in dollars. And it should be no less than $300,000, as I said, to be just reliable enough. Here we have a small consolidation, for example, and when the price breaks the level, it comes sharply to this size, and if you selected it correctly, the price instantly rebounds from it, rebounds from this size, as most participants of the breakout who entered here fix their position here before this limit order, because on their way this limit order is perceived as a resistance. They want to fix, they want to save their profit. And we pull back really instantly. Or the opposite situation, when we have consolidation before the short breakout. Here we have really good limit order in the order book of $300,000, and the pullback is very sharp from this limit order with a stop with a short stop loss. And in this case, it's placed here. So let's consider the main rules. We find huge limit order below or above strong level. The limit order should be no less than $300,000. We place several limit orders in front of this limit order. For example, we are expecting the approach for the short pullback, and we finally place several limit orders in front of this size, spreading the orders on the distance of no more than 0.5% from it, as sometimes price hits the size, sometimes it reverses earlier. So this distance should be no more than 0.5% from this limit order. Using the ruler, you can measure it. The leverage in both strategies should be no more than 5x. We really recommend it. For example, you have $100 on deposit, 5x leverage is $500. So you spread 5 limit orders of 100 in front of the size no far than 0.5%. That's really easy for understanding. For $100 limit order, another limit order for 100, and in total there are 5 $100 limit orders. And finally, the last rule: when you are executed, when the pullback is on the process, we fix the position partially, starting from 0.8% of profit, placing stop loss in the break even, in the green zone. There is a good example, as you see. Here we see several touch to the level and a really huge limit order here. On the graph, it's placed somewhere here. We comes to this after breaking the level, and there is a pullback. Let's watch. Breakout and the execution of limit orders with very short stop loss. I hope the video was clear, and I really hope that the whole course was useful for you. Please use all this knowledge wisely, and this course will probably help you to enhance your trading. See you soon in other videos.